Good evening. We begin tonight with a major development out of China that has sent shockwaves through global commodities markets and captured the attention of precious metals traders worldwide. The Shanghai Futures Exchange, known as the SHFE, has undertaken what industry observers are describing as an unprecedented enforcement action. Over the course of just a few days, the exchange has moved to purge more than 22 trading groups from its platform. This sweeping regulatory intervention has ignited intense speculation and debate within the precious metals community, particularly among those who follow silver and gold markets closely. The action has raised fundamental questions about market structure, trading practices, and the potential for significant price movements in the days and weeks ahead. The Shanghai Futures Exchange is one of the world's most important venues for commodities trading, particularly in the Asian market. It serves as a critical hub where participants from across the region and beyond come together to trade contracts for delivery of various commodities, including base metals, precious metals, energy products, and other raw materials. The exchange operates under the regulatory oversight of Chinese financial authorities and plays a central role in price discovery for numerous commodities that are essential to global manufacturing, construction, and investment activities. When an exchange of this magnitude takes enforcement action against a significant number of trading participants, the implications extend far beyond the borders of any single nation. Trading groups on commodities exchanges are typically organized entities that may include professional trading firms, investment funds, commercial enterprises that use futures markets for hedging purposes, and various other types of market participants. These groups may employ proprietary trading strategies, execute orders on behalf of clients, or engage in market-making activities that provide liquidity to other traders. The composition and structure of trading groups can vary widely, from small operations with just a handful of traders to large, sophisticated organizations that deploy significant capital across multiple markets and asset classes. When an exchange removes a trading group from its platform, it effectively bars that entity from participating in trading activities, which can have immediate consequences for market liquidity, order flow, and price dynamics. The timing of this enforcement action has not gone unnoticed by market participants, who have been following developments in silver markets with particular interest. Silver has been the subject of ongoing discussion and debate within trading communities, especially among those who believe that prices have been artificially suppressed through various mechanisms. Some market observers have long maintained that concentrated short positions, held by a relatively small number of large traders, have prevented silver prices from rising to levels that would be justified by fundamental supply and demand factors. These observers point to data showing that a handful of participants hold short positions that represent a substantial percentage of annual silver production, a level of concentration that they argue is unusual compared to other commodities markets. The concept of a short squeeze has become a focal point for many who follow silver markets closely. A short squeeze occurs when traders who have sold futures contracts, betting that prices will decline, are forced to buy contracts to close out their positions as prices move against them. This buying activity can create upward pressure on prices, which in turn can trigger additional buying from other short sellers who face mounting losses. If enough short sellers are forced to cover their positions simultaneously, the resulting surge in buying demand can drive prices sharply higher in a relatively brief period. The more concentrated the short positions are among a small number of traders, the more vulnerable the market potentially becomes to a squeeze scenario. In the context of the recent enforcement action by the Shanghai Futures Exchange, some market participants are asking whether the removal of more than 22 trading groups could be connected to short positioning in silver or other precious metals. If any of the purged trading groups held significant short positions in silver contracts, their forced exit from the market could potentially require those positions to be closed out, unwound, or transferred to other participants. Depending on the size and structure of those positions, such a requirement could introduce buying pressure into the market at a time when some observers already believe that silver is poised for upward price movement based on supply and demand fundamentals. The Shanghai Futures Exchange has not publicly disclosed the specific reasons for removing each of the 22-plus trading groups from its platform. Exchange officials have not issued detailed statements explaining the nature of the violations or irregularities that prompted the enforcement action, nor have they identified the specific trading groups affected. This lack of transparency is not unusual in the early stages of enforcement proceedings, as exchanges and regulators often conduct investigations and take initial actions before providing comprehensive public explanations. However, the absence of detailed information has left market participants to speculate about what might have triggered such a broad and rapid enforcement sweep. Several possibilities have been raised in discussions among traders and analysts who are attempting to understand the underlying reasons for the exchange's actions. One potential explanation is that the trading groups may have violated position limit rules, which are regulations that restrict the size of positions that any single participant or group of related participants can hold in a particular contract. Position limits are designed to prevent any single entity from accumulating such a large position that it could potentially manipulate prices or create disorderly market conditions. If the Shanghai Futures Exchange determined that certain trading groups had exceeded position limits, or had structured their operations in ways designed to evade those limits, that could constitute grounds for removal from the exchange. Another possibility that has been discussed is that the trading groups may have engaged in coordinated trading activities that the exchange deemed manipulative or contrary to the principles of fair and orderly markets. Coordinated trading can take various forms, from explicit agreements among separate entities to trade in ways that artificially influence prices, to more subtle arrangements involving the sharing of information or the timing of trades in ways that create misleading impressions of market supply or demand. If exchange officials uncovered evidence of such coordination among multiple trading groups, that could explain why a relatively large number of entities were targeted for enforcement action within a compressed time frame. A third scenario that some observers have raised involves potential concerns about the financial stability or creditworthiness of the affected trading groups. Commodities exchanges operate clearinghouses that guarantee the performance of all trades executed on the exchange. When a trader enters into a futures contract, the clearinghouse becomes the counterparty to that trade, ensuring that obligations are met even if one party fails to perform. To protect the integrity of this system, exchanges require participants to post margin deposits and meet ongoing financial requirements. If an exchange becomes concerned that certain trading groups may be unable to meet their financial obligations, particularly if those groups hold large positions that could result in substantial losses under certain price scenarios, the exchange may take preemptive action to remove those groups before problems materialize. The specific characteristics of silver markets may be relevant to understanding why this enforcement action has generated particular interest among precious metals traders. Silver occupies a unique position in global commodities markets, serving both as an industrial metal used in manufacturing and technology applications, and as a monetary metal with a long history as a store of value and medium of exchange. This dual nature creates complex supply and demand dynamics that can be difficult to analyze and predict. On the supply side, silver is produced both from primary silver mines and as a byproduct of mining operations focused on other metals such as copper, lead, and zinc. On the demand side, silver is consumed in a wide array of industrial applications, ranging from electronics and solar panels to medical devices and water purification systems, while also being sought by investors in the form of coins, bars, and exchange-traded products. The pricing of silver in global markets occurs through trading activity on multiple exchanges around the world, with the most significant venues including the COMEX division of the New York Mercantile Exchange in the United States, the London Bullion Market Association in the United Kingdom, and the Shanghai Futures Exchange in China. Each of these markets operates according to its own rules and regulations, but they are interconnected through arbitrage activities by traders who seek to profit from price differences between markets. When prices diverge between exchanges beyond the costs of transporting and financing physical metal, arbitrageurs step in to buy in the cheaper market and sell in the more expensive market, which tends to bring prices back into alignment. This interconnection means that significant events on one exchange can have ripple effects across global markets. China's role in precious metals markets has grown substantially over the past 2 decades, as the nation has emerged as both a major producer and consumer of silver and gold. Chinese mines contribute a significant portion of global silver production, and Chinese manufacturers are among the world's largest consumers of silver for industrial purposes, particularly in electronics manufacturing and solar panel production. At the same time, Chinese investors have shown strong appetite for physical precious metals as stores of value, driving demand for silver and gold coins, bars, and jewelry. The Shanghai Futures Exchange serves as the primary venue for price discovery and risk management for many Chinese participants in precious metals markets, making it a critical institution in the global silver trading ecosystem. For traders who have been following the debate about potential manipulation in silver markets, the SHFE enforcement action carries special significance because it represents concrete regulatory intervention in a major silver trading venue. Those who have long argued that silver prices have been artificially suppressed point to various forms of circumstantial evidence, including the concentration of short positions, the ratio of paper contracts to physical metal available for delivery, and historical patterns of price behavior during periods of increased physical demand. Critics of these theories counter that market prices reflect the collective judgment of all participants, and that short selling serves legitimate economic functions, including price discovery and hedging. The removal of more than 20 trading groups from the Shanghai Futures Exchange provides a real-world event that both sides in this debate can analyze as they assess their views about market dynamics. The question of whether this enforcement action signals the beginning of a short squeeze in silver markets is one that cannot be answered definitively without access to detailed information about the positions held by the purged trading groups and the manner in which those positions will be handled. A short squeeze requires not only the presence of significant short positions, but also specific conditions that force short sellers to cover their positions rapidly rather than maintaining them or unwinding them gradually over time. These conditions can include price movements that trigger margin calls, regulatory requirements that force position liquidation, or fundamental developments that cause short sellers to reassess their market views. Whether the SHFE enforcement action will create such conditions depends on factors that remain unknown to outside observers. Market participants who trade silver futures and options have various tools available to them for managing positions and responding to changing market conditions. Traders can adjust position sizes, modify hedge ratios, roll contracts from one delivery month to another, or employ spread strategies that reduce directional exposure. The flexibility available to sophisticated traders means that even significant events like the removal of trading groups from an exchange do not necessarily result in disorderly price movements. Exchange officials and clearinghouses also have mechanisms at their disposal to manage the orderly liquidation or transfer of positions when necessary, including procedures for auctioning positions to other market participants who are willing and able to assume the associated risks. The broader context for precious metals markets at this particular time includes several factors that market observers consider relevant to price prospects: global economic conditions, monetary policy decisions by central banks, currency exchange rate movements, inflation trends, and geopolitical developments all influence investor attitudes toward precious metals as alternative stores of value. Industrial demand for silver is affected by manufacturing activity levels, technological trends that determine usage rates in various applications, and the growth trajectory of sectors such as renewable energy that consume significant quantities of the metal. Supply conditions depend on mining production levels, recycling rates, and decisions by governments and institutions about selling or holding existing stocks of physical metal. Some analysts who follow precious metals markets have noted that silver inventories in exchange warehouses have fluctuated significantly in recent months, with periods of drawdowns that have raised questions about the availability of physical metal to satisfy potential delivery demands. When the ratio of open futures contracts to available physical inventory rises to elevated levels, it can create concerns about whether sufficient metal would be available if a large number of contract holders decided to stand for delivery rather than settling their obligations financially. Such concerns can influence trading behavior and contribute to volatility in futures prices. The connection between paper markets and physical markets represents an ongoing area of attention for regulators who seek to ensure that futures prices remain anchored to underlying physical supply and demand conditions. The enforcement action by the Shanghai Futures Exchange has occurred against this complex backdrop of market structure considerations, regulatory concerns, and ongoing debates about price formation in precious metals markets. For those who believe that silver has been undervalued relative to fundamental supply and demand factors, the removal of more than 22 trading groups represents a potentially significant development that could alter market dynamics in ways that support higher prices. For those who view current silver prices as accurately reflecting market conditions, the enforcement action may be seen as a routine regulatory matter that will have limited lasting impact on price trends. The resolution of these competing perspectives will ultimately depend on how events unfold in the weeks and months ahead, including any additional information that exchange officials may disclose about the reasons for the enforcement action and any observable changes in market behavior that emerge as a consequence. As we continue to follow this developing story, we will be watching for several key indicators that may provide insight into the significance of what has occurred. These include any official statements from the Shanghai Futures Exchange explaining the rationale for removing the trading groups, any reports of difficulties in the physical silver market that might suggest supply constraints, changes in the concentration of open interest among remaining market participants, price movements in silver futures on exchanges around the world, and any signs of increased volatility or unusual trading patterns. We will also be monitoring commentary from industry participants, market analysts, and regulatory officials who may offer perspectives on what this enforcement action means for the functioning of precious metals markets going forward. The question posed in the discussion surrounding this event asks whether this is the beginning of a silver short squeeze. It is important to note that such a question cannot be answered with certainty at this stage. A short squeeze is a market dynamic that becomes evident through specific observable phenomena, including rapid price increases, high trading volumes, margin calls forcing position liquidation, and public acknowledgement by market participants that they are facing pressure to cover short positions. While the removal of more than 22 trading groups from the Shanghai Futures Exchange creates conditions that some believe could contribute to such a dynamic, the actual occurrence of a short squeeze would require a confluence of factors that may or may not materialize. What can be stated with confidence is that the enforcement action represents an unusual and significant event in a major global commodities exchange. The scope and speed of the action distinguish it from routine regulatory activities. The involvement of more than 22 trading groups suggests that exchange officials have identified issues of substantial concern. The focus of market attention on this action, particularly within the precious metals trading community, reflects the recognition that events on the Shanghai Futures Exchange have the potential to influence global price dynamics for silver and other metals. Whether those potential influences will translate into actual market impacts remains to be determined through subsequent developments. As professional observers of financial markets, we recognize that regulatory actions by exchanges serve important purposes in maintaining market integrity and protecting the interests of all participants. Enforcement mechanisms exist to address violations of trading rules, to prevent manipulation and fraud, and to ensure that markets operate in fair and orderly manners. When an exchange identifies behavior that threatens these objectives, it has both the authority and the responsibility to take corrective action. The fact that such action has been taken on a relatively large scale at the Shanghai Futures Exchange should be viewed as part of the normal functioning of regulatory oversight, even as market participants analyze the potential implications for trading strategies and price prospects. This concludes the first part of our coverage of this developing story from China's commodities markets.